Hi, my name is Kevin Blanche. Today I'm going to talk about what is a credit default swap and why everybody is so venomous and crazy mad at Wall Street. My personal opinion is I don't think America should really be mad at Wall Street. They need to take a look in the mirror and be mad at themselves. Let's talk about credit default swaps and what they really are. All this venomous hate and spew that's been carrying on. I hate Obama. I hate Bush. I hate Clinton. Enough already. I'm blaming Wall Street for all my problems. I'm blaming Washington for enough. Let's get to the heart of what these things really are. What is a credit default swap? What is a derivative? Everybody wants to hate them and hate everything about them. Let's talk about what happened and what they are. A derivative. The derivatives that are most common are futures and options. They're over-the-counter derivatives. Now, what does that mean, over-the-counter derivative? An over-the-counter derivative means there's a transparent market that's been created that you and I can trade in. I've been trading the derivatives market for 30 years. The CBOE is the exchange that makes the one on most of the options. There's all kinds that the American exchange does some. There's different exchanges that do some of it, but they're transparent markets. You go to your brokerage firm, say, hey, I want to trade options. You fill out an option agreement, boom, you're trading options. Now, we're not going to get into covered calls and synthetic spreads and all this thing. I want to talk to you in basic deductive thinking terms that the average American can get a grip what these things are. Okay, so you're trading those. There is no intrinsic value with an option to the actual equity. They're leverage. They're separate. They're abstract. They work on 100 times increments, controlling 100 shares for one. What is leverage? That's how they work, leverage. My finance professor used to say, the legendary Dr. Clyde Cooley used to say, it's like a big old pump handle. The longer that handle is, the more you put down here, the more leverage you create, which will pump and draw it out. That's what leverage is. That's what a derivative is. You're playing against the clock and the price. Calls up, puts down. Percent change over time, the delta formula. It's a mathematical formula that was basically come together with Black and Scholes. They won a Nobel Prize for it, the pricing of them. But you're basically buying time. And you're making a bet, just like people say on TV. You hear people that they're making a bet. Yes, you are. You're making a bet whether the stock's going up or down. But they were created to hedge. Say you bought a stock with a high dividend yield. Say Philip Morris paid 7% dividend yield. You wanted to guarantee it. You bought a put underneath it. That's what hedging is. That's what the derivative markets traditionally are. Well, those are the over-the-counter derivatives. You and I can trade them. They're transparent. Well, what happened? Credit default swaps came along because of this. We started to create this huge, massive subprime mortgage. Look, over the last 10 years, the so-called Bush decade, whatever you want to call it, you couldn't make very little money in the market. The market laid there. Didn't do a whole lot. Okay? Look what interest rates were. Go put your money in CD. You couldn't make any money. You still can't. A couple percent. So people were looking for something. Big firms, countries, sovereign wealth funds, whatever. Subprime mortgages started to get bigger and bigger and bigger and bigger and bigger. They started packaging billions of dollars. These things were returning 12, 13, 14% as a package. Now, who created those? Not Wall Street. No. You and I created those. Homeowners rushing in and pulling equity out of their house because of, now you could say maybe Washington created the Federal Reserve by keeping the interest rate low. That's another debate, and I agree with that. The interest rate was so low that it did create inflationary times. Commodity pricing went through the roof over the last decade. Housing price went through the roof. You know, people say no inflation. Everything went crazy. Gold went crazy. Silver went crazy. Grain went crazy. Copper went crazy. Corn went crazy. Houses went crazy. Because our money did get devalued because of low interest rate. But that's been going on for a long time. That isn't something new that just Obama created. That was going on through the entire Bush administration. It's extremely low interest rate. So people were looking for a high rate of return. So when that subprime thing was being promoted by everybody rushing in and using their house like a credit card, was bubbling up prices, and they were paying 13, 14, 15, 16, 17, 18% for these instruments. And banks were putting them together, and they were getting more and more and more and more, to the point that there were literally billions and billions and billions of dollars these banks were owing. So the bank says, hey, we're going to start packaging these things and sell them as a traded instrument, which is a smart thing for the banks to do, because, and in theory, the banks were getting nervous about holding too many of them. So that's why credit default swaps were invented. They are a derivative market that you and I can't trade in. They're a derivative market that was created between the banks and the institutions that were buying and trading these things to protect themselves, to hedge their risk, to buy a put, to buy a down on it. So in case the thing washed out, that insurance policy would cover all their risk, because they had huge risk and they were getting these big returns. Well, who insured those? Who cared? AIG. Insurance companies. AIG was the big, massive monster, the insurance company. There's just to blame for this thing. They took that bet, they booked that bet, and they didn't cover that bet when it all came falling down. It fell down so fast, AIG didn't have enough wealth to cover it. Even though they were like the biggest, most massive insurance company, one of the biggest, most massive companies there ever was. Sit down and do the math. How much money you pay for insurance, auto insurance, housing insurance, in your whole life. You never get any of it back. That's the kind of wealth these people had and the power. They were taking these bets. They were writing the insurance policy, and the banks were buying these things to cover their risk. And Wall Street was buying these things to cover their risk. And they turned it into a traded instrument. That's how markets work. So I don't believe it was the bank's fault. I mean, you can sit and be mad at Goldman Sachs. You can sit and be mad at Wells Fargo, one of these things. You and I created this mess by running and I didn't run a mortgage on my house, but you know, that's a whole other different subject. You know, it's not that I'm blaming people that did, but I am. I mean, you created it. So that is what a credit default swap is. You and I can't trade it. It's a derivatives market that was traded, and it was created by the banks in order to hedge each other's risk and try to dump off some of the risk of holding these big things that were returning 13, 14%. Look, banks were taking your money in. They're paying you 2, 3%. They're buying credit defaults, or excuse me, they were buying subprime mortgage packages getting 13%. Talk about a disparity. They were making a lot of money. They tried to hedge the risk by inventing credit default swaps, which is a derivative they tried to trade among each other. And when it all came crashing down, it all happened so fast, and it happened at once, it couldn't be covered. The government had to solve it. My name is Kevin Blanche. If you're a hedge fund manager or whatever, I am looking for a new gig. My website is stuckwithdamage.com. Thank you.